Warren Buffett famously pays a lower tax rate than his own secretary, too. And real estate investors like Donald Trump, they often legally pay nearly $0 in federal income taxes, too. Now, you might assume this is some shady loophole strictly reserved for billionaires. But the shocking truth is, this is a completely legal framework regular people can use right now, too. In this explainer, we're going to reveal exactly how that hidden system works. But real quick, we've got to establish a ground rule. While the mechanics we're covering today are real legal strategies drawn from tax law, this explainer is strictly educational. 1, 2. You absolutely must talk to a licensed tax advisor before making any moves, because nothing here is individualized financial advice. 2.
So how do the wealthy legally pay $0 in federal income taxes? Well, it all comes down to a hidden tax rulebook. 1. The biggest financial mistake most of us make is believing that wealth is just about how much money you make. But as this rulebook proves, true wealth is actually dictated by how much money you're legally allowed to keep. 2. The crucial point is that your tax bill is determined by just two core factors: the specific category of your income and your taxable income. 1. You see, the IRS doesn't just look at the actual cash flow you generate. They look at what portion of that cash they've decided is legally taxable. 2. So, to drastically reduce your taxes, your entire strategy basically boils down to either shifting your income category or finding legal ways to artificially reduce the taxable portion of it. 2.
Let's jump into Section 1, the 3 income categories, and how the IRS classifies your money.
Your tax burden shifts drastically depending on how your money was initially earned. 2. The IRS essentially forces your money into 3 buckets: earned income from your job, portfolio income from your investments, and passive income from things like real estate rentals or book royalties. 1. And here's the harsh reality school never taught you. Earned income from a regular 9-to-5 job is the absolute worst, most heavily penalized tax category in the entire system. 2.
Let's look at the actual penalty by imagining 2 people making the exact same $50,000. The W-2 worker traded their time for money, and the system hits them with the heaviest tax burden, too. By the time marginal income taxes and FICA taxes strip away their share, that $50,000 drops to about $40,500. 1. But the investor making the exact same $50,000 through investment income, they legally keep thousands more. 2. Why? The difference in tax brackets between these categories is just staggering. When you work a job, you follow punishing marginal tax brackets that can reach all the way up to 37%. But when you generate long-term capital gains by holding an investment for at least a year and a day, the IRS uses the tax code to actively encourage you. If you're a single tax filer, the IRS allows you to pay literally 0% on the first $47,000 you earn, capping out at just 20% for the absolute highest earners. The IRS wants you to be a long-term investor, so they incentivize you with dramatically lower brackets. But it gets even better. When you make your money from portfolio investments, your FICA taxes, which funds Social Security and Medicare, are hit with exactly $0. 1, 2. You own nothing. So our $50,000 investor pays a tiny fraction in income tax and absolutely zero in FICA, letting them legally keep significantly more money. 1. You completely leave behind those harsh earned income brackets. 2.
Moving on to Section 2, the real estate loophole, unlocking massive paper write-offs.
Real estate offers some of the most powerful legal deductions the entire tax code has to offer, too. And the biggest mechanism is a concept called depreciation. This is a paper write-off, allowing investors to tell the IRS that because their physical property is a year older and experiencing wear and tear, they deserve a massive deduction. 1, 2. The crazy part, the IRS happily gives you this deduction even if the actual market value of your property is skyrocketing. 2. It lets you artificially reduce your taxable income while your actual cash in the bank continues to grow. 2.
Let me show you how staggering this math gets with accelerated depreciation. Imagine your rental property generates $15,000 of pure cash profit sitting right in your bank account. A savvy accounting team can tell the IRS that certain components of your property wear out much faster, unlocking a massive 20% write-off in the very first year. So if you take a $20,000 paper write-off against your $15,000 of actual profit, your taxable income mathematically drops to a negative $5,000. You have $15,000 of hard cash in the bank, yet you legally tell the IRS you lost money, completely wiping out your tax bill.
So, what happens when you finally sell that property for a massive profit? Normally, you'd be terrified of capital gains tax. But real estate allows for an infinite loop called the 1031 like-kind exchange. Step 1, you sell your property for a profit. Step 2, you immediately roll all that money into a bigger, more expensive property. Step 3, you legally pay exactly $0 in capital gains taxes on that massive appreciation. Wealthy individuals literally repeat this exact cycle, tax-free, generating more rental cash flow and bigger depreciation write-offs until they die.
Section 3. Strategic business write-offs shielding your earned income.
What if you don't want to invest in real estate? Well, starting a business or even a structured side hustle provides incredible tax advantages because you can deduct ordinary and necessary expenses before paying a single dime to the government. 2. One of the most fascinating mechanisms here is the newly modified Section 179(1). This tax code rule allows businesses to take up to a 100% first-year deduction on heavy machinery. 2. Ever wonder why internet personalities are always buying heavy luxury vehicles? It's not just to look like a baller for the camera. It's a highly calculated legal tax strategy. 1.
Let's break down the math of the famous G-Wagon write-off. Because a G-Wagon weighs over 6,000 pounds, it automatically qualifies as heavy machinery. 2. Let's say you purchase a $100,000 vehicle, put $20,000 down in cash, and use it 60% of the time for a documented business. 1. You instantly unlock a massive $60,000 paper deduction. 2. Now, looking at this purely through the lens of tax strategy, and definitely not as advice to finance depreciating liabilities, the immediate tax leverage here is just staggering.
So the crucial point is how this affects your bottom line. If your business only generated $50,000 in profit, that $60,000 G-Wagon deduction drops you to a negative $10,000 loss. Your business tax liability is completely wiped out, yet you still have $30,000 of actual cash in your pocket from the profit you didn't use on the down payment. And here's the kicker. If you or your spouse work a regular W-2 job, you can literally use that $10,000 business loss to legally shield your regular paycheck from the government, too. It's wild.
Finally, Section 4, winning the wealth game. Master the rules to keep your money.
The ultimate lesson here is that our financial system is a structured game of incentives, and unfortunately most of us go our entire lives without ever learning the rulebook. 1, 2. As you start to earn and invest more, your absolute highest return on investment will be hiring a true tax strategist. 2. A cheap accountant who just files your returns will ultimately cost you thousands in late fees and overpayments. 2. A real tax strategist meets with you monthly or quarterly, analyzes changes in the tax code, and actively plans how to shift your income and lower your taxable income before the year even ends. 1, 2. They help you actively play the game.
Everything we've discussed today boils down to one powerful truth. It is not how much money you make, it's how much you get to legally keep. Once you understand how to change your income category, control your taxable income, and utilize legal write-offs, you can take complete control of your financial destiny. So I'll leave you with this question. Knowing what you know now about the hidden rulebook, how will you restructure your income to stop playing by the hardest rules?